Well, it's time for our Chapter 3 lecture. In the book, I'm starting on page 71, and today we'll be talking about the accounting cycle and the mechanics of accounting. And the one thing we haven't really gotten to yet is the rules of debit and credit, and that's where we'll get some stuff going today about accounting and how we do actually do transactions and journal entries. You can see here that the accounting cycle is made up of four parts. Number one is we analyze a transaction, and a transaction, just think of it as anything that affects the financial position of our company. Okay, so in other words, um, we do something. We have a delivery van. We buy gasoline to fill it up. There's a transaction, something that affected my financial position. Um, Number two is we record the effects of these transactions. So number one is we analyze them. We have a source document. I've got a gas station receipt. I look at that and go, okay, I know I did this today. Number two is, how do I record that transaction in my books? Step three is to summarize the effects of the transactions by posting journal entries and preparing a trial balance. Okay, so step three then is basically doing your accounting for the day. After the day is over, you've got a stack of source documents, receipts, invoices, and so on. It's time to take that information and turn it into journal entries. Um, Once we post the journal entries, then we prepare something called a trial balance. Step four is to do adjusting entries, prepare financial statements, and close the books. Okay, so that's what we're going to talk about today is all those steps and a little bit more in chapter 4 also. So between chapter 3 and chapter 4, that's what we'll be going through. Okay, so remember the accounting equation, right? We know that assets equals liabilities plus OE. OE is owner's equity. So just think ALE, assets equals liabilities plus equity. Okay, and every transaction will affect both sides of the accounting equation. Okay, well, I shouldn't necessarily say both sides. It'll make, if it's an asset, if one asset goes up, another asset could go down. Okay, but here's some prime examples of transactions and how they will affect the accounting equation. And you can see here the first one, borrow money. Well, if I borrow money, I have more cash, right? A bank is giving me cash, but I have a liability. I now owe the bank more money. What if I invest in a company? What if we decide to invest in somebody else's business? Or I'm sorry, what if somebody invests in our business? What if the owner puts more money into the company? Or if it's a corporation, if we sell stock? Well, then we have more cash again. We receive cash, and we also receive more equity. What if we pay off a note? In other words, just think of what's the process? What if we pay off a liability? Well, we have less cash because we write a check to pay for it, but we also have less liability. We owe less money. The next one, purchase equipment. And there's where assets can go up and down. Let's say I spend cash to buy another asset. Cash goes down because I'm spending it, but the asset I'm purchasing goes up. So let's say I spend $20,000 to buy a delivery van. Um, Cash goes down by $20,000 if I write a check for 20, but my delivery van asset now goes up to $20,000. So one asset goes down, the other goes up, both in the same amount. And then finally, the last one says borrow funds to settle a debt. What if I'm refinancing debt? What if I'm borrowing from one company or one bank to pay off another bank because I've got more favorable interest rates or just better repayment terms? And so obviously, one liability goes up, one liability goes down. Okay, so we'll next talk about T accounts and terminology to help analyze transactions. You can see here that we have a T account, and you can see it's called a T account because you've got a horizontal and a vertical line that make the letter T. Okay. Now, one thing to keep in mind is T accounts are set up the same way all the time, and that is the name of the account is at the top, and debits are always left, and credits are always right. That will never change. That is always that way. Okay, debits left, credits right. Probably want to make a note of that. No matter what the account is, debits are on the left side and credits are on the right side. Okay, so it's just a simplified depiction of an account. Okay, and think of an account as something that's tracking the changes in an account balance during an accounting period. We'd have a beginning balance, various debits and credits that happen as we record transactions throughout an accounting period. Then finally we get down to an ending balance. Okay, so they start to show us T accounts. Really, we see some in the book, really not until about page 76. And so they kind of show us some example T accounts there. And they note that the debits are left and the credits are right on that page. Okay, double entry accounting. Remember that accounting always affects two things. Dual effect is something you might hear, or at least double entry like we see here. Okay, number one, debits must always equal credits. They have to be the same. If you were using a general ledger software system, like a QuickBooks, for example, or a Peachtree, your journal entry won't work unless it balances. If it doesn't balance, it ain't working. Okay. For every transaction, debits equal credits, and the accounting equation will balance. Okay, the accounting equation has to be in balance at all times, before and after every transaction. Okay, that's really important because we're going to be doing our accounting manually. We're not learning how to use accounting software in this class. This is all about learning and understanding the mechanics of accounting. Why we do things that we do, and then how we analyze the numbers. Okay, so you're going to be doing this in Cengage now or pencil and paper to figure it out. You don't have a software system checking your balance for you. Okay. Well, here's the expanded rules of debit and credit. And I don't think we've looked at this yet, and this is important to understand. This is just going to be one of those things that you'll have to memorize. And it's in the book, pages 76 and 77. You'll also see this exact same chart on page 78. So make a note, pages 76, 77, and 78 are what you want to look at. And you can see here that this expanded accounting equation, you've got assets, liabilities, and equity at the top. And notice that debits are always left and credits are always right, just like I said. But then equity, they break that down into various pieces. Okay, notice that capital stock and retained earnings are just simply additional components of equity that pertain to a corporation. And then under retained earnings, you have revenues, expenses, and dividends. So let's just walk you through the whole thing here. We know what assets are. Assets are economic resources that will benefit our business in the future. Okay, so things like a building, a delivery van, furniture, equipment, computers, assets that we acquire to help us earn revenue throughout the years. Okay, notice that debits are the plus side, credits are the minus side. That means if I'm going to increase an asset, I debit the asset. If I'm going to decrease the asset, I credit the asset. Okay, so if I receive cash through, let's say, owner investment, I would debit the asset. I would debit cash. I'd have more cash. Okay. How about liabilities? Notice that liabilities are the opposite, where debits are minuses and credits are pluses. Okay. So if I take out a bank loan, I now have more liability. I would credit liability. As I pay off the bank loan, every time I make a payment, I would debit liability. How about owner's equity? With owner's equity on the right, notice that same thing, credits are pluses, debits are minuses. So as equity goes up, I give it a credit. As equity goes down, I give it a debit. Okay. So I want you to also notice that this equal sign, I like to think of that as kind of like a dividing line. On the left side, debits are pluses, credits are minuses. But if I flip it over, if I just focus on liabilities and equity, it's the opposite. Okay, where now credits are pluses and debits are minuses. Okay, so now we've got kind of the main three ironed out. Let's kind of drill down into equity. So capital stock and retained earnings have the same rules of debit and credit as owner's equity, where credits are pluses and debits are minuses. Okay, But then when it comes to retained earnings, I need to break that down. So for a corporation, just think of capital stock is a corporation selling stock and receiving par value. And we'll get into what that means in a future chapter. Okay, but it arises from either owner investment or selling stock. Okay. Retained earnings then belongs to the earnings of the corporation. As we have net income, which is more revenue than expenses, retained earnings goes up. If we have a net loss, which is more expenses than revenue, then retained earnings goes down. If we pay dividends, that reduces retained earnings. Okay, so ultimately think of it this way. Revenues are good. They make equity go up. Okay, the more revenue I have, the more capital I will have. Okay, so as I have more revenue, equity goes up. So revenue has a plus for credit, just like owner's equity does up above. Okay, expenses make equity go down. As we pay expenses, we have less equity in our business. Now, think of it this way, though, that for all revenues, we also have expenses. For every revenue, there's an expense. Okay, sometimes you can't make a direct correlation, but you can say that for every revenue, there's an expense to be incurred. Okay, so expenses are the opposite of revenues with the rules of debit and credit. A plus increases, or I'm sorry, debit is a plus, so debits increase expenses, credits reduce expenses, opposite of revenues. Okay. Also think of it this way, that when we pay money out to our shareholders, that decreases revenue. Okay. So dividends here, as they get paid out, we have less retained earnings. We're returning equity back to our shareholders. And so that reduces retained earnings. You can see here, debits pluses, credits minuses. Okay, same as expenses. So revenues make capital go up, or let me say equity. Revenues make equity go up, expenses and dividends make equity go down. Okay, so the rules of debit and credit is just one of those things you have to memorize. Pages 76, 77, and 78 are where you would look. Okay. Also, I'm going to post a file under handouts. It's called the Rules of Debit and Credit Tutorial, and that will help you also. I'm going to do a little recording about that one, so that will be coming up also. Okay, next is journal entries. We have to record journal entries as a transaction, as activity happens. We have to turn that into a journal entry. Okay, so journals and journal entries. A journal is an accounting record in which transactions are originally entered. It's a chronological record. Chronological means organized by time. So think of it this way. Okay, think of having an 8.5 by 10 piece of notebook paper in front of you, and imagine that was your journal. And if you were doing a journal by paper, that's where it would start. Okay, you start at the top and work your way down. Let's say it's February, so we're going to start out with the first part of the month, February 1. We'll start our business. We'd start a new page of a journal, and we'd write down the date. We'd write down the accounts to debit, the accounts to credit, the dollar amounts, move on to the next transaction, and just move on down that piece of paper organized chronologically by date. Okay, at the top is the beginning of the month, and we just work our way down as the month happens. Okay. So a general journal format, you can see down at the bottom there in the green box, we debit an account and then we credit an account with a date and an explanation. The explanation just describes to us what this journal entry is trying to accomplish. And debits must equal credits. And we always indent the credit account name a little bit, a couple of spaces here. As we gather information, as we have source documents like a receipt or an invoice, we have a three-step process to identify how to do a journal entry. Okay, the 3 steps are right there. They are: identify which accounts are involved, determine which accounts are increased or decreased, determine by how much has the account changed. Okay, so those are the 3 things to be thinking about for every journal entry. So here's an example. Let's say we're going to purchase $250 worth of inventory for cash on January 30th. Remember the three-step process, okay? We're going to buy inventory, that's an asset. If we're purchasing something like an asset, it's going to go up. So now we have more asset. But I'm giving up, what am I giving up to acquire the asset? I'm giving up cash. So cash is an asset also. So one asset goes up, which is inventory, but another asset goes down, which is cash. Okay, one asset goes up and one asset goes down. Three-step process. Date, debit the inventory account because it's going up, credit the cash account because that is going down. Also notice the brief explanation, to purchase inventory. Okay. Now in your book, I want you to make a note that after page 78, beginning on about pages 80, 81, 82, 83, or 84, so 80 through 84, they're going to walk you through several sample transactions and show you the actual journal entries in a general journal. Page 81 has a very good example of a general journal on it, where you can, looks kind of like an 8.5 by 10 piece of paper with different columns to organize each journal entry, a column for a date, a description, and a debit column and a credit column. So pages 80 through 84 will walk you through the examples and the how-tos of doing a journal entry, in addition to the examples that I just gave you. So here's another example right here. And compound journal entry. Compound means there's more than just one debit and one credit. Now we could have a couple of debits and or a couple of credits or more. Okay, so there's multiple accounts that we're going to be debiting and crediting in the same journal entry. Okay, so more than one debit or more than one credit or both. So now here it is, we're going to make a mortgage payment. Let's say we've got a mortgage on our business. Let's say we bought a building or some property for our business and we obtained a mortgage to be able to finance it, and now we're paying that mortgage back. Okay, we're making a mortgage payment. Typically we're going to do this every month. So our payment's $175, and of this we know that $150 goes to principal and $25 goes to interest. Now we don't have to imagine what those numbers are. If this was a real transaction, we would have that information from our bank to know exactly how much of the payment went to principal and how much went to interest. Okay, so we'll debit interest expense. We're incurring more expense, right? We have interest expense to record every month. When we make that payment, the payment represents interest and principal. So $25 is interest expense. To increase an expense, we give it a debit. Also, we're paying off part of the loan. Okay, so as I repay the principal of a loan, that reduces my liability. So I'm debiting mortgage payable. I'm reducing how much I owe the bank, and then I'm crediting cash. Okay, so I am paying an asset, giving up the asset cash, and now I have less cash, less asset. So expenses goes up by a debit, liabilities goes down with a debit, and then assets goes down with a debit, with a credit. And finally, I've got my brief explanation at the bottom. Okay, I then have to post my journal entries from that general journal to something called a ledger. Okay, so posting means transferring the amounts from the journal to the ledger. Now the ledger says a book of accounts where journalized transactions are posted and thereby summarized. Now when you do this in class, you're going to either do this in T accounts in Cengage now or in something called a 4-column ledger. But just imagine if you could just kind of think through, if we're going to do this on paper, what would a ledger look like? Well, just think of a 3-ring binder. Okay, just think of a small 3-ring binder, inside of it multiple pages of paper. Okay, and each page of paper represents an account. So we'd have several asset accounts first. You'd have cash, accounts receivable, inventory, building, land, equipment, organized by current assets versus long-term assets. We'll talk about what those are in the future. Okay. Then your liabilities, like an accounts payable or a note payable. Then your equity accounts, like a capital stock, retained earnings. Then your revenues, then your expenses. So it's organized according to the accounting equation. Okay, so that's part of this, but every tab represents an account. So every tab or every piece of paper in that ledger, just think of it as a giant T account where we're keeping track of the account name at the top, the various debits and credits after that. Okay, and then we're organizing this all the way down. So every time we increase an asset, we give it a debit. Every time we decrease an asset, we give it a credit. And then we have to subtotal and count the account balance at some point in time also. And we'll go through examples of that. Okay, so here's a general ledger. And this is what they call the 4-column, or I guess this is actually more of a 3-column in this setup. But notice what they're showing us here. Okay, this is keeping track of a particular account. This is inventory. Okay, so on January 1, our beginning balance was $100. And then every time something happens, actually, I'm sorry, this is cash. I said inventory, this is cash. So every time something happens, to increase or decrease cash, we record it here. Okay, so right here, issued 100 shares of capital stock at $10 per share. We're going to debit cash for 1,000. We sold stock, received cash back, so we'll debit cash for 1,000, and now my account balance is 1,100. The 100 plus the 1,000. Then I'm going to buy equipment and pay cash. So I'm going to write a check. I have less cash, I'll give it a credit. My balance is now 800. I'm going to sell some inventory. Of course, if I sell inventory, I'm getting paid for that. I'm receiving cash back. I received $60, so now I've got 860. I'm going to make a payment on a loan, which is writing a check, decreasing asset, and now I've got a balance of 630. Then finally, I'm going to earn some revenue, debit cash, and I've got a final ending balance. Now, this GJ1 means this entry, this amount, came from General Journal, page 1, and this date. So we're always leaving ourselves clues about where amounts came from, and that's the whole point of the GJ1 is if I need to retrace my steps, if something isn't balancing and I want to go through and check all of my numbers again, I can go back and look at page 1 of the General Journal and verify that that $1,000 is the correct amount to record right here. Okay, next is the trial balance. And the trial balance is simply a list of all of our accounts with their respective debit and credit balances. It's a way to prove that debits equals credits and our accounting equation is in balance. Okay. From this data, the balance sheet and income statement can be prepared, which are our financial statements. So we use a trial balance as a source document to prepare our financial statements. So it's just simply a list of all the accounts and their respective debit or credit balances. Here's an example of a trial balance. Now keep in mind also, when it comes to trial balances, every account has either a debit or a credit balance, but not both. Okay, you can't have both a debit and a credit balance at the same time. It's one or the other. It's one or the other. They give us an example of a trial balance in the book. You don't get to see one way until page 96. But they'll walk us through some examples of posting from the journal to the ledger. You'll see some examples between pages 92, 93, and then 94, and then you finally get to see the trial balance on page 96. So roughly between pages 92 to 96. Here's a sample financial statement right here. Here you will see an income statement, and then you'll see the balance sheet. If I go back a screen here and show you, let's see, the trial balance is right there. I lost my spot. So let's go back and look at the trial balance again. And let's look at some of the account balances. It's a pretty simple trial balance, not many accounts. You can see there's cash, some inventory, some land, a big liability here, note payable, capital stock, some revenue, some expenses, and it all balances. Look at the revenue and the expenses. 3,200 of revenue, 2,200 and 100 for expenses. And look at my income statement then. See, there's that same revenue number, there's the same expense numbers, and there's my net income of 900. Okay. Earnings per share is earnings divided by shares outstanding, 90 cents per share. Look at my balance sheet. Those same numbers that are on my balance sheet came from my trial balance. Okay. Now, your retained earnings number, though, is, let's go back to trial balance. Let's look at capital stock here. Capital stock is 20,000. That's my only equity account. If I go to my income statement, remember that net income was 900. And then look at my retained earnings balance here. So my equity is capital stock of 20,000 plus retained earnings. Retained earnings is 900. It's a brand new company, first year of earnings. Beginning retained earnings was 0, plus net income was 900, but there were no dividends. So that's my ending equity. We'll get into more detail about that in the future. Here's a cash flow statement. Remember that cash flow is organizing sources and uses of cash. Where does cash come from and where does it go? Organized by 3 categories of operating, investing, and financing. Okay. So beginning cash was 0, brand new business. Ending cash was 7,900. Some cash came from operations. Some cash was used in investing. Some cash came from financing. And we'll get into more details about that in the future. Okay. How have computers changed the accounting cycle? You can see right here, and I should tell you real quick then too that the example financial statements in the book are on pages 96 and 97. The discussion about computers is on page bottom of 99 and then on 100. Obviously, computers automate things, make things go faster, quicker. Calculations can be done by the computer, eliminating the human component because we know that all humans can make mistakes, right? We can mistype a number, we can do some bad math, whatever it is, okay? Computers ease posting of journal entries and summarizing data into reports and financial statements. You can literally run a report, okay? You can literally just run a report that will show you what your financial statements are. You can run a trial balance. You can then, after you run your trial balance, you can run your financial statements, okay? Computers can't think though. That's your job. It's sometimes your job to understand, do the numbers make sense? Are the numbers that we're getting out of the system, are they meaningful? Are they accurate? Are they correct? Are they wrong? And so we can spend a lot of time on automation and computerization of accounting systems. That's a completely separate class that we offer. So we're just learning how to do this thing manually, okay? Because we have to understand the rules of debit and credit, how to do financial statements manually, how to post from a journal to a ledger manually, all those things to really be able to understand accounting correctly in the best way. Okay, I'm going to stop this one. I'm going to come back and we'll do a review of a problem here after this recording.